This is China Gateway 360. China just changed the game for foreign investors. We're diving straight into how the new foreign investment law is fundamentally reshaping entry into China's massive clean energy market.
So what we're looking at right now is a clear, pretty aggressive trend of liberalization. You know that 40-decade patchwork of mandatory joint venture requirements? Well, the foreign investment law just replaced all of it. By updating their negative list, they've actually dropped restricted sectors from 48 in 2019 down to just 28 in 2023. And it's exactly this progressive reduction that finally unlocked wholly owned operational freedom in some really key green tech areas. Now, this entire legal framework is essentially built on 4 core pillars. But if you're operating in the clean energy space, your crucial takeaways are really national treatment and intellectual property protection. When you put those two together, they provide a newly unified legal basis to actually resist forced technology transfers. Plus, it gives you the leverage to push back against those discriminatory localized practices that have, let's be honest, historically hindered foreign entrants.
But, as you might expect, this new openness isn't just uniform across the board. The real market opportunities today sit in highly unlocked sectors. Think electric vehicles and energy storage. And those stand in pretty sharp contrast to solar and wind, which, despite being legally open now, remain structurally dominated by localized markets.
To really grasp the tangible impact of these unlocked sectors, you just have to look at the sheer scale. Removing those new energy vehicle manufacturing restrictions meant Tesla's Shanghai Gigafactory could pump out 947,000 vehicles in 2023 alone. But here's the most important part. They achieved all of that as a wholly foreign-owned entity. No local partner required.
China Gateway. Gateway.
Your gateway to business in China.
Building on that exact momentum, the 2023 negative list update specifically unlocked energy storage, and that triggered some immediate, high-growth investments. We're talking about Tesla's 40-gigawatt-hour megapack factory, as well as Northvolt's major push to scale wholly owned proprietary battery production right in China, targeting both domestic and export markets.
However, the landscape shifts pretty dramatically when we look over at wind and solar. Over here, foreign firms are facing what is essentially a massive-scale deficit. Domestic giants control over 70% of the market, and they're fueled by these deeply integrated supply chains and local labor costs that run 30 to 40% lower than their European competitors.
Because that sheer domestic dominance has made foreign module manufacturing largely uneconomical, surviving here really requires a strategic pivot. To find success in these sectors now, you have to move away from hardware scale. Instead, it's all about pivoting to project-level technologies. We're talking things like microinverters, O&M software, and advanced cell chemistries, technologies that can actually be properly protected under this new legal framework.
So what strategic posture should you actually take? Well, here are 3 executive takeaways for you. First, maximize your operational control by establishing wholly owned subsidiaries. Second, compete on differentiation, not on hardware scale. And third, weaponize the legal framework. Use the new law's mandatory 30-day comment periods and anti-discrimination clauses to actively negotiate and push back against local government friction.
Ultimately, while local implementation gaps definitely still persist on the ground, the foreign investment law currently offers the most favorable legal environment we've seen in a long time for targeted technology-focused entry into China's green energy sector.
Would you invest in China? Tell us why below.